Welcome to the latest episode of The Bridge by iCapital. I am Sonali Basak. I am iCapital's Chief Investment Strategist, and this is where we bridge you to the top investors in the world and the greatest voices in finance. And today, we are joined by Rob Sechan. He is the founder of NewEdge Capital. Thank you for joining us here because we're sitting here at Goldman Sachs. It's really a conversation about the wealth management industry, but it's a complicated juncture in the macro. While we're standing at record heights in the S&P 500, what's on your mind, Rob, these days?
So principally, I run the business day to day. We have a wonderful, fantastic investment team that gets to think about all the things you're talking about. I obviously do. I started my career as an advisor and still maintain clients on a day-to-day basis. So I know the things that they're thinking about. And, right now on the business side, we're thinking about how do we grow the business in an intelligent way and continue to support elite advisors wherever they are on their journey. And right now, that's employing great technology, surrounding them with wonderful intellectual capital in wealth strategy and investments, and then ultimately giving them access to unique and differentiated products, services, solutions. And, if you can do that, it creates some virtuosity that ultimately leads you to attract more and more advisors. I think we've been really successful at that in the last 5 years, growing from $4 to $5 billion all the way up to $100+ billion. I would argue we're one of the faster growers out there. I'm very proud of that. The people that we have are exceptional. From an investment standpoint, on a day-to-day basis, we're obviously looking at this disconnect between where valuations are and where enthusiasm is and what's happening in the world. And, you can't talk about what's happening in the world without talking about what's happening in the United States. So the United States is kind of this island of hope, this island of prosperity that is not feeling the same strains and stresses that the rest of the world is. And so you constantly watch for, is that going to spill over into what's happening here? And ultimately, something's going to knock us off this trajectory. At the same time, I also worry about the narrowness of the market. And when we're going to start to see some broadening out. Now, we're seeing it in earnings, but we're not seeing it in price performance, nor has it meaningfully impacted earnings enough, right? So I do believe in AI. We're using AI very effectively in our company. And I see the productivity gains for us. I can only imagine in different industries where there's force multiplier type effects that will drive that forward. So I spend a lot of time thinking about a lot of things.
Yeah, well, this is where I wanted to go with this, because if you think about the clients that you do service at NewEdge yourself, right? They're among the largest pools of capital, and want to get into how they're thinking before we get to strategy at NewEdge and your plans for growth and scale. But when you are a high net worth investor, ultra high net worth investor, you look at this concentrated market, you want to diversify, I would imagine, aggressively. No?
Well, you do want to diversify, but when you look at what's happening fundamentally in these businesses, what's happening kind of should be happening. They are driving everything right now. So it starts out with this foundational layer that is being built out, and then the use cases will get built on top of it.
Do you mean the AI story that is driving this bigger market? It's hard to diversify.
And the companies that are laying the groundwork for this, the NVIDIAs of the world and all the hyperscalers and the like. And, at the same time, you got to wonder whether the market accepts them going from cap-light businesses to cap-heavy businesses, meaning they're having to invest. And this is an absolute arms race. My personal belief is if you don't fight in the arms race, you're going to be behind in the war. And so they need to do it. And I realize they get challenged episodically. Meta right now is a great example of a company that's being challenged because of their spend. You can always pivot spend. What you can't pivot is when you fall behind. So I think they're doing, all these companies are doing the right thing. I do think that ultimately, though, we need to see the application and the benefits of that spread out. I believe they will. I think we need to have the energy infrastructure to support that. I believe we will. I know that a lot of people are worried about, what happens to the jobs market, right, as a result of all this AI happening and what happens to entry-level white-collar jobs. We are great at retooling. There were no social media influencers before the internet. There were no web designers before the internet. And so the economy is so dynamic, I can't help but be enthusiastic about it. But I also, because I've lived this a long time, know that sometimes we pull forward enthusiasm in price. And so you have to look for inflection points. You have to look for changes in the rate of change. We at NewEdge have brought on people far smarter than me to look for those inflection points, like Cameron Dawson and Brian Nick and Jay Peters. They're exceptional. And hopefully we can identify when the risk becomes too great. But right now we're comfortable that the concentration is well supported and hopeful that everything that's built on top ends up being a force multiplier to that build out.
What does it look like underneath the surface? It's interesting to hear you say, well, yes, everything's still underpinned by AI, so people want more exposure to it. Mm-hmm. But what are some of the best ways? Because when we go around the country, we talk to a lot of clients, what's hard for us is to listen to them say, I want more of the 5 big names that have already gotten large. How do you position your clients for the investment opportunities of tomorrow?
We definitely own those names, not every single one of them, but we do own them, and we've only bought them when they were at reasonable prices. So we're happy to hold them because we're tax-efficient investors, and so buying them at the right time when they fit within our valuation parameters, and then holding them over time makes a lot of sense to us. We also believe that the semi theme is really strong. That's outside the hyperscalers. We own a lot in that space and think that was a great way to get that exposure. But then there's other categories of beneficiaries, and if you can just look for quality companies, and everybody says that, but these are companies that have great profitability, high return on invested capital, they're trading at reasonable valuations. Who do you think is going to be able to make those investments to use AI and become productive using it? That's not the only story we do. There's great businesses outside of AI. We just looked at our 5-year track record. NewEdge is basically 5 years old, and we are both a wealth and asset manager. So if you look at our assets, we're probably running directly somewhere about $6 to $8 billion of the hundreds that we do. So we allocate more than we run. But of those that we run, we are top 20% in every category in which we run money in, and top 1% in 3 of those. So we run in 5 categories. So we believe we have a secret sauce in terms of how we fundamentally value businesses that don't need to reside in the kind of hyperscaler or semi space. We've had success in energy, we've had success in healthcare, and international, which has been a market that's been challenging at times and has recently resurged with repatriation of assets back to those countries. And I think if you follow a model of quality, you will be able to participate no matter kind of what cycle you're in.
So I do want to get into this business model, the asset and wealth a bit, because I want to understand for the funds that you do manage, what would you say your edge is? Your new edge?
Yeah, so listen, it's a marriage of technology with great intellectual capital. We are quantamental investors, and the math never lies. Okay, so if you can identify trends in the math, we are able to use those to help us have a decision framework and then put an intelligent overlay on top of that to drive the decision process. I think you also have to be fee efficient for clients because this is effectively beta. Right? So if you're going to charge more than the ETFs are, you have to bring some level of value, right? And the value that we bring, I think, is rooted in technology and execution on top of that technology. So if I were to put our strategies, I put them between active and passive, right in the middle. And they produce some of the best results available in the market as a result. I went to Carnegie Mellon University, both undergrad and business school. I'm a math guy at heart. When I look at the numbers rarely lie.
So the extent to which you allocate, you had mentioned you allocate more than you oversee when it comes to assets. How do you choose your managers? What are the qualities of the next fund that you would like to be putting clients in, and who oversees it? What excites you?
So I don't oversee it, but
Your team.
The team is definitely focused on high caliber boutique managers that are vested in their businesses, that themselves have maybe a different edge than we have, that are complementary to the things that we do on a fee efficient, tax efficient basis, and are additive from a diversification standpoint. Sometimes we find that in traditional asset classes where they're exceptional managers in a category, and other times we find them in alternative asset classes where we really don't have that capability directly. We're allocators. And so, we are being pitched constantly. The RIA community has become the new darling to pitch. So we have no shortage of opportunities from which to select. History is a great indicator to what may happen in the future, but you want to ensure that performance wasn't luck, it was skill. And how do you do that? By doing deep dives on the process that drove those results.
So ultimately, when you're talking to one of your own clients, right, this is kind of the holy grail, and what are the types of opportunities you're excited to bring them?
Our core strategies are great. Think about them as anchor tenants in the mall. But when you think about what is different today, I'm excited that we sit center. So we can talk to Goldman Sachs. We're at Goldman Sachs today. We can talk to JP Morgan. We can talk to all these firms and truly move to the same side of the table as the client and solve for them, family, client, make sure that they're seeing the best of the best out there. When I think about the opportunity set, I like private directs, for sure. That is something that has been a great market to invest in. We've invested in DuckDuckGo, XAI, OpenAI, SpaceX, Reddit, all kind of, I believe that's become the new IPO market, right? So clients getting into those strategies through our special purpose vehicles, doing co-investments with some of our private equity partners, where there's a ton of independent sponsors out there that are going after businesses, and they have a unique edge, and we're doing one-off transactions. So when you're with a family and you're bringing something different, that excites me because they don't see that from many of the big firms. That's one. Number two, I think steering into disruption. Forward returns go up when there's disruption. I was kind of hoping there would be a little more disruption from the headline news and private credit, because I will tell you some of our best outcomes have been driven by, let's say 22, we had that big tech drawdown, right? Forward returns in venture went up. We actually thought venture debt, because they didn't want to raise equity at that time, was a great opportunity. It turned out to be one of our best performers, right? So I call them eye of the storm assets. Sadly, things have been so good for so long, there's not many eye of the storm assets that are obvious. Right now, I think real estate might be starting to emerge as an attractive asset again. I think infrastructure is incredibly interesting from a yield standpoint, and just a fundamental tailwind with investment in infrastructure. I think that's going to be pretty exciting. Non-correlated is pretty exciting. We're doing a lot of things with one of our advisory board members, Kyle Bass, who is doing things in the defense space. He's also doing things in the land space, conservation land. Those are interesting to clients. Tom Lee, who's on our advisory board, he's gotten us recently enthusiastic about the infrastructure that underpins runs the financial services industry, which will likely be built on Ethereum. So there's so many things to do that you can be overwhelming, but different clients have different objectives. And from my lens, what you need to do is start with a goals-based framework. What are we trying to achieve? And a lot of these exciting opportunities, if they're not needed, why complicate things?
Yeah. I mean, the thing that I love about what you just said, it feels like we have not seen the eye of the storm for the next big opportunity yet. I love how you put it like that. But you have a lot of places where it's time to sow a lot of seeds, places that can become big once they become big very quickly. Would you say that that's the idea?
Yes. I mean, that's why you have to make sure that you're focused on these kind of second derivative type things. If this, then that.
Yeah.
I always say this, and it's if you're walking down the street and something's falling from the sky, let's say there's a piano, and it's coming right at your face, you're not going to get hit by it because you see it. Pianos hit us in the back of the head. Okay, so by definition, something that happens should be a surprise. I can guarantee you it's not going to be what we're worried about today. When I talk to clients, I'm worried about the war, I'm worried about this, I'm worried about that. No. Markets desensitize to front burner issues the longer they're on the front burner. So Y2K is probably the best example of that. When I was young, I'm like, everybody's worried about this thing. And it was out there, it happened, and it was like a candle burning out.
Yeah.
It is something that markets can adjust to over time the longer it stays front and center. Obviously, if there's some cataclysmic escalation, then it could change things. Louis Bacon has a great saying that I believe in from an investment lens, and that's you ride a wave. And every now and then, as something comes in and knocks you into a different atmosphere. And it's at that point where you have to adjust your strategy. Okay? It's very rare when that happens. I think this AI is like a Manhattan Project for being knocked into the next atmosphere. And you got to stay in an athletic stance if you're a client and be ready to read and react. But it doesn't mean you have to throw out everything that has held true for a very long time. And one of those things is quality investing.
So this is why I was asking you a little bit earlier about diversification, because I think if you're an investor today, it's impossible to really diversify. Because if you are weighted towards the AI theme and you're looking at infrastructure, well, boy, energy prices are being impacted by this build out. If you're looking at real estate, all of the biggest funds are headed right towards data centers. And so do you think that people should be diversifying or just leaning a lot more heavily into AI, knowing that it will be pervasive?
That's an interesting question. In any crisis, correlations go to one anyway. Diversification is for purpose. It's not necessarily just to mitigate downside. One of the reasons to diversify is somebody may need more of an income stream than somebody else. Somebody may have enough exposure on their personal balance sheet in a certain asset class that you need to counter that. And counter it in a lifestyle management way, a goals-based way, versus just an investment way. And that's why I think this industry has changed so much to marrying personal financial objectives through wealth strategy, trust and estate planning, philanthropy, simplifying complexity. If you look at our family office business, which is something that's really exciting that we're doing right now, we are making significant investments in creating structural edges. One example is private placement life insurance, right? How do you have these diversified assets and wrap them in a way that they're tax efficient? Because most of the time, if you're using hedge funds and kind of volatility strategies and opportunities that with all the vol we have in the world that they can really take advantage of, well, you're brutalizing clients from a tax standpoint. So how do we handle that? Another issue that kind of faces the industry and why alts aren't always adopted as quickly as they should is the success that the public markets have had have led to a lot of embedded gains, okay? And so it's tough to sell that, re-rate the portfolio value down because of the tax obligation, and then deploy again.
Right.
So your forward returns have to be higher because you're taking a tax hit. Obviously, there's strategies that have been created to mitigate some of that, but there's many things that kind of govern what can be done versus utopia if you had complete flexibility.
So a little earlier, one thing you had said was that you wish people took a little more advantage of the disruptive moment that we're in, or that there wasn't as much disruption as really met the eye when it came to the private markets this year, private credit in particular. I keep telling people this. I'm really curious to get your view on this because the headlines were worse than the reality on the ground. And in the position I sit in, at least, a lot of people were really looking at ways to chop around the edges and start to get into this industry at a time where realistically, to your point, disruption leads to opportunities. A hardening market could lead to better returns. So how'd you play it?
So listen, we have a number of providers that we're invested with that we're incredibly confident in their underwriting standards, the way they put out capital, and we underwrite that risk too, and so we're confident in the underlying position. So I think number one, picking a partner that can help you pick the right partner in that space makes a lot of sense. I think you also should have a basket of those type of managers. I wouldn't put all my chips on one horse. And there's a lot of talent in that space, and it's a necessary space. I also would understand that the industry has been impacted by an asset liability mismatch that has been created by evergreen funds. And I think, we've never sold them as evergreen. They're illiquid with liquidity in normal circumstances, okay? So you have to make sure that you're guiding clients on the way in so there's not this panic. Everybody reacts to headlines. That's the nature of being a human being. The ability to sort through the noise and make sure it's not something more systemic is important. I think we did that, and we're confident in the things that we own that they weren't going to be impacted quite as badly. But I got challenged. I do TV shows just like Cameron and everybody, and I got challenged on my views on private credit. Everybody was saying this is the end of the world, or it's the end of the Blackstones and the KKRs and their stocks. And listen, these are still mostly institutional investors that support these. Retail is coming up the curve. This is a learning experience for retail that we can't get enormously excited. The structure of this market is one that the equity sits beneath this. So to kind of get impairment, you have to have companies turn away. We're seeing some of that. Thoma Bravo turned away from, I think it was Thoma. And obviously there's going to be some sort of workout. I doubt that it's going to be a donut, right? So,
right, people forget that even if you're in the worst situations, the recovery value is usually not zero. 100%.
So I think we've all just got to take the temperature down of those type of things. I think one of the things we're good at and why advisors are an important asset, even in a world that's evolving towards do-it-yourself and more technology to enable that, there's no substitute for experience. And a calm hand can help you navigate through difficult environments.
So, interestingly enough, I mean, one question I really have about this is I've been soul searching a lot. What was there to be learned from the first quarter of 2026? Right? I don't know if you feel the same way, but a lot has happened. We've been getting so many questions from so many types of investors on, okay, well, what next? What comes out of all this?
I'll tell you what I learned.
Yes, please.
Don't fight the White House.
Okay.
I mean, every bet that has been made, you could have made this an investment policy, frankly. The reality of it is the desired outcomes have manifested themselves. Now that could change, but they have as it relates to markets. I've learned that also that the Fed's probably not going to be able to cut, given what's happening, the way we all expected. But the economy is much more resilient than we would have ever thought. I've learned that our efforts in energy independence have been one of the most important things we could have ever done over the last several years. And so I sit here only worried really about valuations. And, John Waldron just gave a great talk on how we're in a world with inflation that has moderated, earnings growth that is accelerating, higher equity allocations by investors, and that should lead to high multiples. So maybe we're in a persistently high multiple world. So maybe I'm wrong about worrying about valuation.
This is maybe the biggest debate on my desk.
Is that right?
Yes. Are we in a 21 times, 23 times, headed towards 25 times future? Does the American capital markets demand higher multiples because of the technological innovation? Jury's out.
I don't know if it's because of the technology innovation. I just think households are holding higher amounts of equities. And what does that do? It pushes up price. And the amount of equities available are less. So if you're holding higher amounts and there's less available, doesn't that drive up multiples?
All it makes me want to do is hold hard assets, to be honest with you. Right?
All right.
But to your point on worries about valuations, right?
Yeah.
I mean, the question is, at these heights, do you keep on going overweight, or do you find other places to be?
So I think at the margin you find other places to be. And our incremental dollars are flowing elsewhere, but realize that our equity allocations, if you're not a trimmer, they're increasing too. So you don't necessarily need to add. The challenge is when somebody comes into a new amount of capital.
Which is happening a lot these days. We're about to have an enormous amount of wealth raining onto Silicon Valley in the wake of these IPOs.
And so they're going to be faced with the decision of, how do I take some liquidity? Where do I redeploy that liquidity? And how do I go about doing that? And that's a challenge. It's not a challenge for us to give them the advice. It's a challenge for them to go from cash to this with, what if it goes down? And the reality of it is, if you have the right time horizon and you create a structure on, this is what you need, based on this outcome you're desiring, this is what you need to do, it becomes self-evident to kind of bucket the liquidity, the lifetime investment, the long-term post-life investment, and categorize them in a way that each of them has an objective, and therefore you can obviously take on more risk than you think if you're solving for each of those buckets.
So, last topic for you. You started this conversation talking about the potential of AI in your business. I'm wondering what kind of payoff you're already seeing. Clearly, this is a very important part of how the wealth management industry might grow moving forward. I find that not a lot of firms are actually using AI, particularly not in a meaningful way. You've grown so much in just 5 short years. What role will AI play in the next phase of growth?
So, we didn't pick some old person's last name as our brand. We picked NewEdge, and the reason we picked NewEdge is because we wanted to occupy different shelf space. I don't know if you know the history of the firm, but the firm was actually born out of a buyout. My partner, Parthenon Capital, with private equity firm, bought a business that was what I would describe as a tech-enabled solutions business for the 401k industry. This is a business that we announced the sale of yesterday. But what a great foundation. The reason we grew so fast is we started halfway up the mountain. We had this great institutional-grade infrastructure that was the infrastructure for Paychex and John Hancock and Creative Planning and all these firms for their 401k businesses. So it was bulletproof, okay? But what were they good at? It was tech enablement. So it was like the iPhone. They were taking different technologies, integrating them into an ecosystem that created advantages. And so the way we thought about it is, If we can embrace tech, NewEdge, always be on forward thinking, and bring advisors and their clients the greatest technology that's available, that will drive a structural advantage. And so we are, if not the first, one of the first to announce using Enterprise Cloud. So everybody has it on their desktop, everybody's able to use it, we're in a firm-wide relationship, and we encourage our advisors to use it. We encourage them to use it in email, in analytics, and all these things. And obviously, we have all the safety protocols because our DNA is in tech enablement. And ultimately, what I think that leads to is use cases are born out of users. And I'll give you an example for me. We're working on a pretty large acquisition. When I was an investment banker long ago, junior investment banker, an MD would hand me something, I'd run off and do analysis and come back to him the next day. I sat at my computer with my spreadsheet, my Anthropic next to me. I would say, what if we do this? 2 minutes. You could iterate back and forth. And it gave me an ability to make a decision that should have taken months in week.
It feels to me like Anthropic is the advisor to the advisor.
It's and I've used this word many times, it is a force multiplier. Listen, I don't think it's going to replace our people. What I think it's going to make our people so much more efficient that maybe we have to hire less people, but this is still a people business. I think people want to talk to somebody that understands that use case. And I think where the disruption is going to happen is if you have employees that are scared to use it. So the reason we at the top of the firm, like James Jesse, who's our CEO, Alex Goss, who runs our Powered By business, our 1099 channel, he's unbelievably passionate about this. If you have the leadership team of the organization hell-bent on making sure they're using it, it starts to spread throughout the whole organization. And it creates, I think, a culture of using technology to be the connective tissue, not the disruptive tissue, the connective tissue between you and clients and you and being smarter. It takes good employees and makes them great, and it takes great employees and turns them into super people.
What does this mean for you in terms of scale? I mean, this is an industry that has been very desirous of scale. Does this help you amplify that scale in a meaningful way, or is that not something you worry about?
What I worry about is quality. So, and I worry about culture, and I worry about the fit of the people that we're allowing to join us in our wonderful journey. And the thing that I've promised every partner that joins this company is that I will not compromise on the quality of people that they would want to call their partners. So that's what governs our scale, is that. If we can find 10,000 great people and be an organization like Goldman Sachs someday, I want to be that. I think there's going to be 5 RIAs that occupy hallowed ground in terms of size and reputation. I think we will be the McKinsey, the Blackstone, the KKR, the Goldman Sachs of that world. And we're going to do that not because we embrace technology, but because of our people.
Rob, it has been so nice to talk to you, and it's been really nice to follow you on this journey. I'm looking forward to more of it. That is Rob Sechan. He is the founder of NewEdge Capital Group, and you've been watching The Bridge by iCapital.